HP Inc. Let's bring in Wamsi Mohan, Bank of America Securities Senior Analyst. Wamsi, does this change the thesis at all? I know you have not been a big fan of HP.
Yeah, thanks for having me, Sarah. No, this really is not a thesis changer. When you look at HP, this is a stock that has held in extremely well because of the fact that they were a huge pandemic beneficiary. You saw a big uptick in both PC spend. You also saw a disproportionate amount of value come from the hardware side within printing, which is very unusual. In fact, if you go back in time, PCs were 25% of profit. Through the pandemic, they became 40% of the profit. Now, there's going to be some mean reversion on this. We fully expect PC trends to start to decelerate. We've already seen that on the consumer side of things. We think it could even percolate to enterprise over time. Spending on the print side has been, it's mixed, right? Like you're back to the office for toner, but at the same time, you have a lot more of the higher profit margin ink at home that's going to come under pressure. So we think the earnings stream itself is going to renormalize lower, and that's what keeps us cautious on HP, despite the fact that obviously Warren Buffett's taken a stake in the company.
But Wamsi, the counter argument, isn't that already in the price? The valuation on this stock is pretty low. Both Dell and HP have been driven lower even lately on concern about enterprise spending. So is that not already there? And what you're left with is a strong cash-generating sort of valued tech stock, which is why it might be appealing to a Berkshire Hathaway, but also appealing in this kind of environment.
Yeah, so it's a great question. And if you look at, Sarah, like what the free cash flow generation has been, they're tracking about $5 billion or so in free cash flow. Can that re-rate lower to 4 to 5? I think that's not in consensus numbers. I don't think it's even in the buy-side estimates at this point in time. The reason that the multiple on the stock has been so low over time is because that people don't have the confidence entirely that this company will be able to alleviate and walk through some of the secular pressures that they have. But that said, I think that some of what is reflected in valuation is a slowdown on the PC side. What is not reflected in valuation are more dire scenarios of a larger slowdown, either in PCs or on the print side. So free cash flow goes between 4 and 5 billion. The rate and pace of buybacks has to come down. The capital return cannot sustain 7 billion every year. They're not saying that it's going to sustain that in the near term. And going into next year, since they've already done this acquisition of Poly that's underway, it's going to leave even lesser room for capital return. So the capital return thesis is predicated on strong free cash flow. PCs turn negative with a negative free cash conversion cycle. For the cash conversion cycle that's negative, that puts even more pressure on the capital return story.
Wamsi,